Okay, so you should see Excel now. We're going to continue. So remember yesterday we stopped by the revenue of the restaurants. So if we have a look over here, we need the revenue of restaurants, which is with other guests. So now we're going to continue with with the revenue calculation. We're going to move on to calculate the revenue for bookings because we're going to need because remember we still need to calculate two types of revenues. You have four revenue sources. Number one, in no particular order. Number one, it is revenue from the restaurants. But the restaurants have two types: your normal guests and then other guests. Okay, so we have the other guests. So we must still calculate your normal guests or your whatever you want to call it. Then the third one is your revenue from conferences. And then the fourth one, which is the main one, it is your revenue from bookings. Now, in order to get revenue from, in order to get revenue, to calculate revenue for the restaurants based on your guests, we need to have the revenue from your bookings calculated first. The reason being is the revenue from guests requires the number of people, the number of guests that we will have. So the way we'll get the number of guests is when we calculate revenue from bookings. So it's quite a complicated, well, not want to say complicated, but it's not a simple calculation. So we will go through it a little bit slowly. Let me just see what you're seeing. What are you seeing? What do you guys see? What do you currently see on your screen? You should see the PDF scenario.
Yes, we can see that.
Okay, so make sure that you see the right thing. Okay. So remember, we went through the upfront costs and we're now under the motel revenue. So I'm going to read number 8. So they say the average cost for bed and breakfast for each type of room is as follows. So the single room is $80, the double room is $120, and the deluxe room is $170. So during weekends, the occupancy rate is expected to be 100% for all types of rooms. So remember, so weekends, so each room costs that a price, and then for weekends, there will be 100% occupancy. So what does that mean? Um, so we need to work out how many rooms there are for each type and then how many days there are in the year. Okay, so we have to split out weekends versus weekdays. So let's just quickly see how many rooms are there. I think I read when we read the scenario the very first time, it told us how many rooms there are. So here they say the motel has 25 guest rooms, which comprise 40% single rooms, 48% double rooms, with the remainder being deluxe rooms. Okay, so 40, 48, that is, how much is that? That is 88, so 12% will be deluxe rooms. Okay, so let's have a look. So if we go into workings, you'll be able to work out the room split. Okay, so we just have working 3. So room split. So what are the rooms? It is single, it is double. What was the other one now? Deluxe. Okay. Then we're gonna say percentage. So single rooms is 40%. Double rooms, it was, what was it? 48%. And then deluxe is the remainder, which is 12%. Okay, so remainder is just basically 100% minus double minus single. Okay, total number of rooms. Which is 25, 25, 25. Therefore, we can get the number of rooms for each type. So number of rooms per type. Number of rooms per type. Okay, so what do we know? Is that multiplied by that. So 10, 12, and 3. So now we know the number of rooms. Now we can go about calculating the revenue for each type. Okay, so now we can go calculate the revenue for each type. So let's start off with single rooms. So we just go in that order. Okay, so costs per single room. Okay, so once again, they gave us the cost. Remember, what is not clear, for me, what is not clear, that is something that you will learn maybe by if you do many of your own questions. But what is not clear to me when I just read the scenario, when is that cost? Is that cost the current cost, or is that cost the next period's cost? Is that year one's cost? Because that plays an important role as to know when is that amount representing. Is it the current price or is it next period's price? Because remember, if it is the current price, then we must already make the adjustment, the 10% increase from year one. But it's not clear to me. So what all I'm doing is I'm assuming the price that they're giving us is year one's price. And then I grow from year two. If they gave me the current price, then I would have grown by the 10% from year one onwards. That's something you just need to, maybe when you look at the solution, you can see what they do. And if they increase from year one, then you must know the pricing that they gave us is the current price. Um, and if they did not grow it from year one and they only grow it from year two, as I am doing it, then you know they are the price they're giving us is the price from year one. Very important. That is why it's in many papers they would be more specific as to when does this price relate to, because they're not trying to trick you in that regard. So I just think perhaps uh, an important aspect when writing out the scenario, unless it is an assumed thing that they expect you to know that when the price relates to. So like I'm saying, my final answer may be wrong if my assumption is incorrect. But what I'm assuming is that the price they're giving us is the price of year one. And as a result, we're growing by the 10% only from year two. So like I said, I may be wrong. So we may have to have grown from year one, but I'm not doing that for now. Okay. So that is something you can maybe find out from your lecturers, what is implied over there. So now I'm going to grow it by the 1.1%. That multiplied by 1.1, because I said each year it will grow by 1% for all revenue, all streams of revenue, okay, all types of revenue. Okay, so that is the cost per single room. Now we can say the number of rooms. So we already worked out the number of rooms, which is that 10. Okay. So remember to work out the revenue, it is going to be the cost per room. It is going to be the number of rooms. It is going to be the number of weeks. It is going to be the number of weeks, the number of days per week that the room is occupied, and the number of guests per room. So just keep you working out the total revenue. So let's just assume there is one room, okay? You want to know, so let's just take it for this example. Let's say you have a spare room in your place, okay? So you thought, okay, you know what? I have a spare room, or let's say I have a spare room at the back of your place, or there's a separate, or you turn a garage or something, but you have a spare room available. So you realize that the spare room is not being used. So you come up with the idea that, you know what? Let me rent out this room like an Airbnb. So you know what's Airbnb, right? So you rent it out like an Airbnb. So you want to work out what is the revenue you would earn for an entire year on that room. So you would obviously know that the way you would work it out is that you'll have to have the price per room. Okay. So what is the cost per day for that room? So in this case, the cost for that room is $80 per day. So you have that one aspect. But $80 per day is not your revenue. I mean, that's not your total revenue. How will you get your total revenue? It will be $80 per day, but it depends upon how many days your room is booked for the year. Okay, so it is $80 per day, but it all you know that your room is not going to be booked out for 365 days a year. So you need to work out or come up with an estimate as to how many days per year do you expect your room to be booked. So in this case, the way they give us that is by saying the number of days per week that the room would book. But remember, then we'll have to get the total number of days for the year. It will be the number of days per week multiplied by the number of weeks per year. That will give us the total number of days that we expect the room to be booked for an entire year. So if we use that example, picture yourself owning a room and you are renting this out on Airbnb. You want to work out you want to work out now already what you expect your revenue to be. So it's $80 per day. You have one room. So it's $80 per day times one room. So the maximum revenue per day you can get is $80 because $80 per day per room, you only have one room. So the maximum you can get is $80 per day. But now you're saying, okay, you want to work out revenue for the entire year. You know that the revenue that you're going to make is the days that your room will be booked is not necessarily going to be 365 days of the year. So you come up with an estimate. They gave us an estimate. So the way we work out the number of days for the year based on the information given is by saying um, number of days per week times number of weeks per year. So we know that. Then we will have to work out how many guests per room. Because remember, you may charge $80 per day per guest. So in this case, it's only one guest per room. So therefore, it will only be $80. But if you have two guests per room, then you may want to work out how you want to include the number of people. So just picture that. Okay, so here we have the cost per room, the number of rooms. Now we want to get the number of days per year. The way we're going to get the number of days per year is by working out the number of days per week booked and then number of weeks per year. Number of weeks per year. But their pricing works different. It also depends on the number of people per room or number of guests per room. So we're going to say number of guests per room. So that should give us our revenue. So let's just see. So they're saying, where am I reading now? Number 5. Number 8, sorry. So during weekends, the occupancy rate is expected to be 100% for all types of rooms. During weekdays, single rooms are expected to have an occupancy rate of 80%, 60%, and double rooms 75%. Deluxe rooms are not very popular due to their cost and are expected that only one room will be occupied for 2 weekdays. One room will be occupied for 2 weekdays. A year is considered to have 42 weeks. It is assumed that all deluxe and double rooms will be occupied by 2 guests. So let's have a look. So we already have, this is going to be weekdays. Let's do the weekdays first. Okay, so number of days per week. What did they say? 60% of single rooms will be booked per week, right? So how many days in a week? Remember, not 7, 5, because they separate weekdays from weekends. So in a week, there's 5 days, and there's only 60% of single rooms will be booked each week. So that is 3 days. In number of weeks per year, we know it is 52, so we can just drag it across. And then for single rooms, there's only one guest per room. So therefore, revenue is going to equal that multiplied by 10 rooms, multiplied by 3 days per week, multiplied by 52 weeks per year, multiplied by 1 guest. Okay, so that is going to be that revenue. Now we can just copy and paste all of this and change the variables. So that is single room weekdays. We can do single room weekends. Okay, so single room weekends. The cost per room is still $80. We're happy with that. Okay, the number of rooms is still based on this. Still 10 rooms available. And remember, the number of weekends, number of weekend days in a week is equal to 2. And they say weekends are fully booked, so 100%. Okay, so it's that. There are 52 weeks in the year, and there's 1 guest per room. So therefore, we have that amount. Now we can do the same for, what's the other one now? Deluxe. Let's do, what's the other one? Double.
Double rooms.
Let's do double. So now we're going to go double room, weekdays. Double room weekdays. The cost of double room is $120. So there that changes because 10%. The number of rooms for double was 12. So there we go. There's 12 rooms. The number of days per week is still 5. But what's the occupancy rate for doubles? Each week, 75%. Okay, so on average, it will be that. Number of weeks per day, 52. Number of guests for double rooms is 2. So we can change that. Okay, so we're happy with that? Any questions so far? Over here?
Hello?
Yes?
Sorry, I just want to confirm about the 10% that you were adding to
the price.
Yes, to the price. Where did you get the information?
Where did I get that? I'll show you now. Number 11, all lines of revenue are expected to increase at the rate of 10% per annum. Okay, well, like I said, I'm not sure when does that apply. As because it's not clear whether the pricing they're giving us is the current price or whether it's year one's price. So you may need to increase from year one. I'm only increasing from year two because my assumption is that the prices they're giving me is the price of year one. So the increase only takes place from year two onwards. So once we get the solution, we will be able to confirm whether this pricing is the current price or whether it is year one's price. Generally, an example, we make it very clear. I can't pick it up from the example, so I don't know. So my assumption is I'm assuming that is year one's price.
Okay, thank you very much.
Okay. So now if you go to the double room weekends, it's still 120. And now what did I just do here? It is 120, and there we go. It is increasing by the 10%. Okay, this will be still the 12 number of rooms. Okay, there is two weekend days per week, and it's 100% fully occupied, so multiply by 100, so that's fine. There are 52 weeks in the year, we're happy with that. But for double room, there are 2 guests per room. So there we go. So double rooms are sorted. Now we can deal with the deluxe rooms. So this is a lot of work. This is a lot of
Sorry,
work. If you yes,
sorry, Faiz. Sorry to come in.
yes,
So the number of guests is we are using the assumption that each person is paying $120 or $80, right? So that means in a particular room we are getting double because of the number of people that have occupied the room.
yes.
Okay.
Many many hotels work like that. Some hotels will charge you a price. So whether you're one person or 2 person, you still pay the same price. But some hotels charge you per guest. Okay. So if you just Google, then you look at pricing. Sometimes they will say $100. I'm just making up numbers. $100 per room. Sometimes they'll say $100 per guest. Okay, so when it's per guest, they charge each one per price. So that is that over there. Now let's work on the single. Okay, now let's do the deluxe rooms. So now I'm going to do the deluxe rooms. So this is a lot of work if you're not using Excel. I'm using the same formula. You have to write this out. It's quite time consuming.
All right. Sorry,
Yes.
Faiz, because I'm seeing the question is saying average cost for bed and breakfast for each type of room is as follows. So is that where they were supposed to specify in the guest issue again, or
Say again.
I'm saying they are saying cost for the room is actually $80 per room, but it's not specifying whether they are charging for the number of guests.
Yeah, they're not. So where they confirm it is over here. Where did I see it? And the point number 8, the last sentence, it says, it is assumed that all deluxe and double rooms will be occupied by 2 guests. So you can assume that this is per person. Okay, they should make it clear. They're not making it clear, but that you can only assume. It does not make sense. It does not make sense to charge $80 for one person. Well, it could be like that. Yeah, that's actually I'm not 100% certain how you'd actually do that. We'll have to confirm as well whether this is, because remember what they're factoring in over here is your a single room is not as nice as a double room. A double room is not as nice as a single room. I mean a deluxe room is not as nice as a double room. So each room will be a bit more improved, and that is why there's the increase in costs. Other thing to factor in is that they're putting in breakfast. So each person had to pay for their own breakfast. And just the way they're wording it, that they're telling you that each room, what each room will have the number of guests. So you would assume that they are charging you per guest. It is not, like I said, it's not crystal clear. In another exam, like for example, if I'm gonna pick up a psych exam, these type of things wouldn't be making me guess, because they're very clear on what it is, because they're not trying to trick you. This is not they're not trying to trick you with this. I just think that the person setting the paper haven't clearly thought about how would someone think about this. So for example, when psychists set a paper, they consider how would this person, that person, and this person read this question. They try to remove ambiguity, but they're not trying to trick you. All they're trying to do is test the principle. So over here, it is not 100% clear. But why am I assuming this is cost per person? Why am I assuming this is cost per person? Is the fact that they're telling me this. It is assumed that all deluxe and double rooms will be occupied by 2 guests. So for me, I would assume that is a cost per person and how the hotel industry generally work. So that is, like I said, I can be wrong. This is not 100% clear over here. But whether I'm right or wrong, that should not be a problem, because it's not a principal issue that we're getting wrong. It is just how you're reading it and what you think it is. You must only be worried if you get something wrong as a result of a principle. If it's a non-principal issue, like it's a non when I say principle, it's not a technical thing that you must go read in a textbook. Okay, so if that's not the problem, it's okay. If you get it now wrong, we don't worry about that, because it's not something fundamental. It is just basically how you read this question. So the way I'm reading the question is that room is costing that price per person. And how do I know that, or why do I assume that, is simply as a result of this last sentence. So whether I'm right or whether I'm wrong, I'm not too worried about it. Why? Why I'm not worried? Because it's not a principal issue I'm getting wrong. It's just how I'm reading the question. So if I'm wrong, it's because the way I read the question, and someone else would probably read the same like me. Two other people read it different to me, and that is why in an exam a question goes through 2 to 3 different people, solely because of this issue. How will you read a question? I remember one of our lecturers, when they said the question, they had to send it to one of the professors. And he said, when it comes out of the professor's office, the whole question is changed, not from a principal point of view, from a wording point of view, which he used to tell them, a student can read this, how you worded it, a student can read it in 5 different ways. We need to make it so clear that a student doesn't, you don't have more than one interpretation. So like I said, once we get the solution, these kind of issues you can iron out. You say, okay, now you know what they meant, whatever, but it's what is the important aspect? Is it a principal issue that we're getting wrong? The answer is no. So you don't worry, don't stress about it. The only time you want to get a little bit worried if it's a principal issue, because that means you must go back and go see, why did you get it wrong? What was the principle that you got wrong? But if it's a non-principal issue, it's very easy to fix up. So like I said, I'm not too worried about it, because if it is not right, it's easy to correct. Okay, so you guys can go have a look, or you can see me the solution once you have it. Then I will have a look, and so now I'll check 2 things. But it's non-principal issues, so don't worry too much about it. Very, very easy to fix up. Okay.
So,
So let's do deluxe rooms weekdays. A deluxe room is 170. Once again, we have to check this. Where do they do the increase? I'm doing the increase from year 2 onwards. The number of deluxe rooms was 12%, which came to 3 rooms. Where is that now? Which comes to 3 rooms. Now we need to work out the number of weekdays, the number of days per week. So they are saying, so this is a little bit tricky, so we need to think through it clearly. They're saying deluxe rooms are not very popular due to their cost and are expected that only one room will be occupied for 2 weekdays. One room will be occupied for 2 weekdays. Okay, so I'm assuming once again it's not clear what it is, if it's 2 weeks for the 2 weekdays for the year, or is it 2 weekdays per week? Okay, so it's not clear. So I'm going to assume there is 2 weekdays every week. 2 days is being booked, but only 1 deluxe room and not 3 deluxe rooms. Okay, so just be aware of that. So let's go plug that in. So what we're going to have to do over here is 2 weekdays. So remember now, where are we? Okay, so are you happy that over here it is 100 and the cost per room is 170. There are 3 deluxe rooms, but how many rooms are booked per week? There's only 1. So we're going to change that to 1. Are you happy? The number of days per week is 2. They told us that. The number of weeks per year, 52. They told us that. And number of guests per room, 2. So that is what I would get to. Okay. Over here, cost per room, 170. Number of rooms is 3. Number of days per week, 2. Number of weekend days per week, there's 2. 100% is occupied, so it's 2. Number of weeks per year, 52. Number of guests, so that is what my amount would come to. Now we can work out total revenue booking review. Total, let me just do this. This is quite a challenging one, but at least it's making it as real as possible. Because this is how it is in the real world. If you can just kind of think of a hotel or how you booked out, that is basically how it would be. So revenue for year 1 would be the sum of all of these. So it is because there's 3 rooms, there's 3 type of rooms, and each one is be split between weekdays and weekends. We should be adding up 6. So that's 3, that's 4, that's 5, and that is 6. Then you add that up. Okay, so now we can take this 2. So if I come over here, it's going to equal to think it was working for. Let's go check. I think it's working for. Yeah, so this is going to be working for. Okay. So that is that calculation. Do you have any questions you at least follow besides those two issues we need to finalize? But from a general point of view, you get what was happening over here? Yes or no? Is there anything still confused? And if I didn't do the question, if we didn't cover it, would you be able to have figured to do it like this? So, anyone want to just quickly say? Hey, Justin, I see you there. You want to say? Want to comment quickly before we move on?
All right. I think it's now much clearer. I actually tried to work out this like we had said yesterday. I think now, since the last session, I think I'm now having a better picture on this net present value calculations. I don't think I could have done it this way.
Okay.
Yeah.
There are two issues we need to figure out now. The one is when the 10% must actually take place, and then number two, it is whether this 170 and that 120 is the cost per person or the cost per room. Okay, I'm assuming it's cost per person. Eddie, anything from your side before we move on?
Nothing. You can move on.
Okay. Evangelista?
I think all is well. We
Okay.
can move on.
Okay.
Yes.
Daddy?
Yes, I'm okay. Yeah, we can move on.
Okay. Tao?
We can move on.
Yeah.
Sure, we can move on. Fine.
Okay.
Thank you.
Here's the last. I think it's Walter. I think he's not.
Everything is okay, fine. We can move on.
Cool. I think that's all. Yeah. Some other reason my thing is not swiping up and down. Okay, there we go. Walter. Yeah, that's the last one. Okay. So let's move on. Now, there's still more revenue. One more to calculate. So the one we need to still calculate is revenue restaurants, the guests. Okay, so if we go, it's under point number 9. All guests are expected to have supper, which will cost 18, and lunch, which will cost, and then all guests are expected to have supper, which will cost $18 per plate for the daily budget. Daily buffet. Lunch will be bought by 80% of the guests on all days at a cost of $12 per individual. Other than the guests, okay, we read that part. Okay, so we know for supper, all guests will buy supper at $18, and then for lunch, only 80% of guests will buy lunch at $12 per person. So if we go working 5, so once again we're going to be working out restaurant revenue. So it's going to be I just copy this. So this is going to be supper. Okay, so for supper, okay, cost per person, it is $18. Okay, so it is $18. And we assuming from here it's going to grow by 10%. Okay, now we must get the number of guests. Okay, number of guests. So the way we can get the number of guests is basically so this is basically the number of guests. There are 3 rooms multiplied by, so there are 3 rooms and each room is booked twice a week. There are 52 weeks and there are 2 guests per room. That will give us the number of guests. Okay, so just take note. That will give us the number of guests. So what we can do to make it easier, so under each of this, we're going to work out number of guests. So under each of these, we're going to work out number of guests. Okay. So here you can see the number of guests. There are 10 rooms. Each week, each room is booked 3 times a week. So each room is booked 3 times a week. There are 52 weeks per year, and each room has 1 guest. So for the year, we will have the single rooms in year 1, there will be 1,560 guests. So I can just drag that across. Okay. I can take the same formula and apply it over here. So if we have a look, there are 10 rooms. Each week, both weekend days are booked. There are 52 weeks and each room has 1 guest. Okay, so you get the gist of the formula. So you don't have to redo it, just copy and paste this over here. So that's a nice thing of Excel. You can just shift around. I'm not sure how do you guys write. You guys go into write, or are you also writing online like Unisa?
We write on physical papers, Faiz.
Oh, so there's going to be a mission. Total number of guests. And how many marks is a paper? You write for 100 marks.
Yes, 100 marks.
How long?
30 minutes reading time. 2.5 hours to write.
Okay. Squad. This must be in the exam. Just good luck. So the number of guests is that for the year. So we can just take that. Okay. That's from working for. Percentage of guests purchasing. Okay, so remember I said all guests will buy supper. So 100%. So here we have revenue. So we can just use the same format. So it's going to be 8 cost per meal, 18 Rand, $18. Number of guests for the year. Percentage of guests that will acquire, that will buy food, is that. Okay, let's do it like that. Now we can just copy this. So now I'll just copy this. And this is now lunch. It's $12 for lunch. That's what we know. Number of guests is the same. But in this case, only 80% will be buying. So there we go. So now we can get total revenue. So now we can get total revenue. You can see it's quite a bit of work, but I hope you understand. You can see the mechanics behind it. So it is that plus that. So now I can just go and plug this in. So it's equal NPV calc that working 5. So that is done over there. Now, so revenue is done. Revenue was quite big. Now let's do this last part. They're saying, member will take advantage of supplying its farm produce to the motel at very low cost. This will be an advantage resulting in an increased gross profit margin for motel restaurant. Gross profit for the restaurant is expected to be at 60%. Okay, so gross profit is expected to be at 60%. So if gross profit is going to be at 60%, then that means cost of the restaurant must be 40%. Okay, cost of sales restaurant must be 40%. So if gross profit is 60%, cost of sales must be 40%. So all I'm going to do, I'm going to say restaurant guests plus restaurant other than guests multiplied by 40%. Because if the gross profit is 60%, cost must be 40%. So cost is an outflow, so therefore I make it negative. You will probably have to show the working, okay? So there we go, that is the cost of sales for the restaurant. Then number 13, cost of sales for motel guests per room include toiletries and laundry for their linen and towels. Cost of sales is 80% of the revenue from motel guests, okay? So 35% cost of sales. Okay, so cost of sales. Room bookings. I'm calling it room bookings. Okay? You can call it whatever you want to call it, but because I call the room bookings under revenue, I'm going to call the cost of sales the same. So it's negative, which is a cost, multiplied by that, and it is the cost of sales is 35%. It's an outflow, so therefore it is negative. So cost of sales motel, okay, that's right. Gross profit, yeah, okay, we're happy with that. We just see regarding the conference room. We just see the conference, etc. Okay, it's fine. Now, under other information, operating costs are expected to be 25% of sales. So operating costs is expected to be 25% of sales. Okay, I'm assuming all sales. Okay. So operating cost, 25% of sales. Operating cost, 25% of sales. I'm assuming all revenue. So it is negative. So all revenue, it is that plus that, plus that, plus that, and I'm going to multiply by 25%. It's negative because it's an outflow, it's a cost. Okay, then the last one under there, working capital injection of 15,000 Rand is required once operations begin, and an increment of 1,000 Rand is required each year. Okay, so working capital, you will need it up front. You guys know Pick n Pay here in South Africa, the grocery store. So for Pick n Pay to actually make sales, they sell groceries, right? So for them to make sales, they need the groceries. So they need the groceries is their inventory. So before they can make sales, they must get the inventory in, first. So therefore, inventory, which is working capital, is required up front. Okay, so that is why we'll put it into year 0. Because you need it at the beginning of the year. Remember, we need it at the beginning of year 1, but we can't put it into year 1 because year 1 represents the end of year 1. So to have it at the beginning of year 1, we put it into year 0. And then this is the increment of 1,000 Rand each year. So there we go, 1,000, 1,000. In the last year, we will just basically get back what we initially spent. Okay, so in the last year, we will just get back what we initially spent. So we'll get back all of that. Okay, so we'll get back $18,000. So remember with working capital, upfront you spend, at the end of the life of the project, you get all the working capital back. What is all the working capital? It is $18,000. But remember, we're getting it back. So therefore, in the last year, it is a positive. The net impact is 0. That's what you want. So why do we show it? Because remember, time value of money is the issue over here. 18,000 in 4 years' time is not the same as 15,000 today, 1,000 in year 1, 1,000 in year 2, 1,000 in year 3. It's not the same, and that is why we need to show the amounts. Okay, so that's a typical thing. They're not going to tell you that in the last year you must get back to working capital. They're never going to tell you that. They expect you to know. So remember, whatever you spend on working capital in the last year, you will get it back. So what did we spend on working capital? $18,000. So therefore, in the final year, we're getting back that $18,000. So that's working capital. Now let's look at number 17. Depreciation is at 25% of the cost of capital expenditure. Depreciation approximates capital allowances. Okay, so we must take that into account. Cost of capital expenditure. Okay, so we have to take that into account. Tax at 25%. Mambo practices tax planning and aims to minimize the tax liability. Wear and tear on commercial buildings is allowable for tax purposes at 2.5% per annum. Interest of 3.5 is paid on a monthly basis. Okay, so once again, if I go over here, I'm going to put in here interest. Interest of $3,500 per month. What we're going to do, it's going to be 0. Why is it 0? Because remember, finance costs is not included in capital budgeting. Now we must work out tax. Remember, one of the 5 principles of capital budgeting, it must be after tax. So therefore, we're going to do tax over here. I'm going to do tax as a separate calculation, which is going to be working 6. Okay, so let me just see, what did we need over here? Buildings, and what else did they have? Okay. So what are they saying with so now I must read number So number 17, they say depreciation is 25% of the total capital expenditure. Depreciation approximates capital allowances. Okay. They say tax at 25.75. Member practices tax planning and aims to minimize the tax liability. Wear and tear on commercial buildings is allowable for tax purposes at 2.5% per annum. So I'm not sure why they mentioned that member tax practice planning thing. I don't know Zimbabwe tax, so I don't know what is it that they are maximizing. Okay, so I'm just going to, that is something you're going to have to figure out on your own, the tax. I'll give you a general way of how to do it based on what I'm reading, but this tax planning aspect I can't deal with because I don't know Zimbabwe tax. So let's have a look at some of the aspects, okay? So working 6, we'll have a workings and then we will deal with tax. So what we're going to do, we're going to bring in all our operational amounts. We're going to bring in all our operational amounts. So as you can see, what I'm going to highlight over here, all of these are initial costs. Okay, so what I'm highlighting in orange are initial, your upfront costs. Okay, what I'm highlighting in yeah, so swimming pool, landscaping, that. Yeah, so all of these are upfront costs. Well, it's actually quite tricky, but okay, let's just do that. And then marketing costs. These are all operational. What is operational is definitely this. These are all operational. Okay, so what is in blue is operational. The marketing cost is a little bit tricky now. How do you see marketing costs? So like here in South Africa, it depends. Okay. So I'm going to take marketing costs as operational. Okay. So once again, I don't know your tax laws. So I don't know what it will be. So I'm just going to use some of my own knowledge based on what South African tax law would have. Similarly with these over here, agency fees, you'll most likely in South Africa be able to capitalize it to the cost of the hotel. The liquor license, once again, probably the same thing, capitalize it to the cost of the hotel. So once again, I don't know. So my tax may be wrong. So I don't know what is the tax treatment in Zimbabwe. I'm just using my own. So like, for example, in something like this, in a like say UNISA's paper, UNISA would somehow tell you the tax treatment. Because they, like from UNISA's point of view, they know that obviously not everybody's going to know the tax. So not only South African people studying through UNISA and stuff like that. So where for you, you are probably just Zimbabwe students, so they assume you're going to know what is the treatment. Okay. So let's have a look. So I'm just going to take this. These are operating costs. And I'm going to bring it in our workings. So all we can do is simply bring the exact amounts in. Okay, so we can simply bring the exact amounts in. So that is easy. Okay, all I'm going to do over here is with the marketing costs, just for this one, I'm going to add that amount. Okay, so that one, this one is 65, but it is year 0 as well as year 1. What you must understand, and I'm pretty sure it's the same thing in Zimbabwe, that although costs in financial management happen up front, the tax consequences will always happen at the end of the year. Because when do you pay tax? When do you submit your tax return? at the end of the year, even if something happened at the beginning of the year. So irrespective where something happened during a year, for tax purposes, it's always happening at the end of the year, unless the question specifically mentions something different, they did not. Okay, so therefore that is okay. Now there's wear and tear. So I'm going to put here wear and tear, and then there's going to be building allowance. Okay, or let's say commercial building allowance. So the only commercial building I can see is the commercial building allowance. The only commercial building I can see is that of the, what does it now? The hotel. Now the tricky part is what forms part of the hotel. Okay, so that is now going to be the issue. So the hotel, definitely the purchase price. Okay, must bring in the resale value, the realizable value that we can bring in as is. So it's equal to that over there. This is not 100% correct. I'll try to fix it up afterwards. So now we need to see what forms part of the cost of the hotel. Okay, so it's definitely going to be the 550. Renovations can also be added, kitchen fittings, all of these. So now the question is, can we add all of these things? I don't know from your guys' things. If this was South Africa law, I would be able to add that to the commercial building. I would be able to add the renovations and maybe the kitchen fittings, maybe the landscape, and maybe this, and then definitely the agent fees. So I don't know which of these from your tax law is part of the commercial building and which is not. This is tax specific stuff. So are you okay if I just assume, or how do you want me to do it?
We can assist you there
Okay.
in terms of the tech side.
Okay.
When they say what do you call, if you go to our scenario where they mention that where NTA something, where that statement is,
Yeah.
tax planning, what they are saying is for any capital expenditure, any expenditure that you think is of capital nature, you put a wear and tear. And the way you have constructed like a swimming pool, because it's if it's of a capital nature, you claim maximum allowances of 25% per each year.
Okay. Okay.
So what they are saying, yeah. And where some costs, remember, there are some costs that are allowed by the commissioner to say when you incur marketing costs, when you incur your motel licenses, your acquisition related costs, under normal circumstances, you must deduct them from your gross income so that you determine your taxable income.
Oh.
That's what you only do. So that's what they are saying. For us, in terms of the hotel, the sale of hotel, yes, they say you have recouped, but they say recoupment is only limited to previously granted allowances.
Yes.
Remember, the hotel, the motel, we are claiming 2.5 per year. So
you wouldn't get in 4 years, you wouldn't get 100%. Yes.
Yes, I wouldn't get 100%. So that's how we do that process.
Okay, so are you okay if I leave out tax then? That is a bit complicated. So I don't know your tax laws. Are you okay if I leave it out and you guys do the tax component? I'll just show you how it gets fit in. Are you happy with that? Everyone?
Yes, we are happy with that fact.
So I'm going to leave tax components out, but you will obviously you can't leave it out. So I'm just going to leave it out because it's I'll have I can do if you send me the solution, I can figure it out, but I don't want to do something that is very different. I'm going to do it the way we do it. So I've listened to what Tao is saying. Some of the stuff from our side is different to the way you are doing it. Some of the stuff is the same. Okay, but so I'm going to leave out the tax component. What you need to know is that you're going to have to include tax over here. The rule over here is if it's a taxable income, if you work out your tax and it's a taxable income, it means you're going to be paying tax. So the tax over here needs to be negative. If it's a taxable loss, it is then and you are able to use the taxable loss against other parts of your business, then it will be a positive over here because you're having a tax benefit. So I'm going to leave that out. You guys going to have to deal with it. This is going to give us our net cash flows. But remember, we don't want net cash flows. We want a present value today. So therefore, we need to discount these future cash flows. So the discount rate must always be WACC. Okay, so the discount rate must always be WACC. I just really want to see what did the question say. Did they give us a WACC rate? Okay, we probably had to use the WACC rate from point A. I'm just going to assume a WACC rate for now, because remember, once again, it's not a principal issue. So let's assume the WACC rate is 15%. Okay, I can't remember, what did we get?
12.7.
What did we get? 14, yeah. So 15% is fine. Okay, so I'm going to assume 15%. Okay, so let's just assume 15%. Remember, this amount doesn't include tax, but whatever I'm going to tell you, we're going to base on whatever number I have. Whatever the tax does to it, you use the same thinking as to how I get my number. So now we're going to get present value. Then we're going to deduct initial costs. Initial cost is simply going to be that year zero's amount. And then we will get NPV. NPV. Okay, so the reason why I have the initial cost over here, the way Excel does it, Excel, if I put in NPV, Excel's asking for my rate. I'm assuming 15%. You will use your WACC rate above, so you're not giving us a WACC rate. So it was 14 point something, so let's just assume 15%. Then they're asking me for value 1, value 2, value 3, value 4. So if you see Excel's NPV calculation, it excludes year 0. So that is why the answer they are giving me is actually the present value. It is not the net present value. In your case, when you use your financial calculator, you're going to put in all the cash flows. You're going to put in the cash flows from year 0. So the answer you get is the NPV. Whereas on Excel, Excel don't include year 0. So the answer Excel gives you is not NPV, is present value. That is why I have to have the separate line initial costs. So to get my NPV, it's going to be that plus that. So my NPV is 1.5. So if you must plug in these numbers in your financial calculator, you will start with year 0. So the answer you get will be 1.5. So you won't have to do this step of deducting because your calculation already includes year 0. So just be aware of that. Now this number may be different. Why? Because it will be different because our one currently does not have tax, but you're going to include the tax because you know your tax treatment. I don't. So do not confuse you. I'm just not going to do the tax aspect. So that is the first part. The first part asked us for NPV. The next part asked us for profitability index. Okay. So based on my numbers, based on NPV, NPV is positive. Because NPV is positive, you accept the project. If NPV is negative, you reject the project. Okay, so when NPV is positive, you accept. When NPV is negative, you reject. Okay, meaning when NPV is greater than 0, it's positive, you accept. When NPV is less than 0, it is negative, you reject. So here it is positive, so we accept. Now, the one profitability index. Profitability index, which is PI, is equal to present value divided by initial costs. Okay, so present value divided by initial cost. So PI is present value divided by initial costs. So as we can see, we already have the numbers. Present value, it is that. Initial costs, everything was being positive. So therefore, PI is simply going to be that divided by that. I'm not sure why they want PI, because they never gave us. It only makes sense if they gave us what is their profitability index range. Okay, so it doesn't make sense if they ask us to calculate this. But basically, if PI is greater than 1, then it's positive. So if the profitability index is greater than 1, then it is good to go, because it means your present value exceeds your initial cost. Okay, but this doesn't mean anything. A profitability index is only used to rank different projects. By having one PI means nothing, because what are we comparing it to? I need to compare this to something. So I need to compare it to project A, B, C, and D, and then see which one is the highest. A PI doesn't say anything. All it tells you, it ranks your project. What are we ranking it against? They must either give us other projects to rank it against, or they must give us a benchmark PI. So the company, let's say the company's benchmark PI is 2. So the fact that it's 2.32, positive, so it exceeds the benchmark, so therefore we go ahead. But if it was, let's say the benchmark was 2.5, then it's less than 2.5, then we reject. But just calculating a PI without comparing it to anything is meaningless. So this PI over here is meaningless, means nothing. Because what am I comparing it to? I'm comparing it to nothing. So what can I conclude? If I'm comparing it to nothing, I can't conclude on anything. NPV is fine, because if NPV is positive, I accept. If NPV is negative, I reject. So NPV is fine, I can accept. But PI, what does this mean? It's meaningless, because the PI only ranks a project. So when I have 3 projects, let's say this one. Yeah. Yeah. Oh, so with a PI over here, I have 2.32, right? So let's say they gave us other 2 projects. The other one is 1.8 and the other one is 2.5. So then that means 2.5 is ranked number 1. 2.32 is ranked number 2. 1.8 is ranked number 3. Now it makes sense, I can rank them. This one I can't rank because there's nothing else to compare it to. So it's somewhat meaningless. So I'm not sure why they wanted us to do it. It would only have made sense if the scenario perhaps gave us a benchmark for PI. I never saw anything. I don't remember reading anything for profitability index benchmark. Let me just see. Right, I can't see anything. I don't know. I don't see. I'm just skimming through. I don't remember seeing a benchmark. So anyway, I don't know what to conclude on this one. This doesn't mean anything. So, but that one is positive. So therefore, you can accept. So NPV is greater than 0. Because NPV is greater than 0, greater than 0 means positive. Therefore, accept. PI, like I said, PI is a ranking. So how can you rank something? Only if you compare someone to someone else, right? So for example, if you watch sport, how do you know which team is first? And if there's only one team, can they be first, second, and third? No. But if there's more than one team, can they be first, second, and third? Yes. So PI is a ranking. So in order to rank, we need more projects to compare to. Okay, so I can't comment on that one, but that's it from my side. Is there any other questions from your side?
Not from me.
Okay. If there's no questions, then we're good to go. I will send you tonight. I'll send you I'll email out the links for the recordings. I'm just uploading it. After this, I'm gonna upload it to YouTube. Then once it's done, I'll send you the emails, and then I'll send you also the workbooks. Okay, then we will have lessons going on weekends as planned, and I'll work through those. I'll work through those mock exams that was sent to me. Okay. If there's anything else you want me to cover, because I'm just going to look through the mock exams. I'm going to see how long it will most likely take. So it will definitely at the minimum take 2 lessons. It may take the remaining 3. I just need to have a look through it. I skimmed through the FAQ one that Tao sent me. So that it's quite a bit of marks. So that's definitely going to at least take 2 sessions, maybe 3. But let me know what else you want to have covered so we can see how we can fit it in the 4 lessons. So we covered already 2 lessons for MAC. We covered 1 lesson for FAC. So there's 3 lessons there for FAC, and there's 2 lessons there for MAC. We're gonna fit in that mock exam for the MAC, and we're also gonna do the mock exam for FAC. If there's anything else that is not in FAC that you want to be covered, just let me know so we can make sure everyone's happy. Okay. Any other questions from
Are we
anyone?
able to do the standard costing, Faiz? Are we able to do standard costing?
Is there no standard costing
Standard
Is
costing.
there no standard costing in the exam? I didn't look through the MAC one you sent yet. I can't hear you.
Yes, it's not there. But I'm saying, are we able? Because the one that we sent is to do with work and what else was there? In the decision, something. But for us who'd want more, maybe that small work and more of standard costing. Tim, can you agree with me? In case I'm suggesting it.
Yeah. If you put it in the chat, then we can confirm before the weekend. Okay.
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 Yes, I agree, Tao.
Yeah, we are.
Okay. So put in the chat, then we can confirm. Then I'll just look for So I don't know if I saw a standard costing in the one you gave me. So
there's nothing. I think standard costing and a bit of variance is there. Thank you.
Okay. So we'll have a look. We can chat in the group. Okay. Okay, guys. I'll see you. Bye bye.
I5S.
Yeah.
I5S.
Okay.
Sorry to take you off course. Are you in a hurry? There is just a question that was troubling me yesterday.
Okay.
I'm not sure if I'm able to share my screen.
I'll give you option to share. Okay, you can share.
So it's okay, it's IS 12. Is So I think it's one of the South African papers. Are you seeing the question now?
Yes, I can.
All right. So I can't figure out how to come up with the carrying amount of these investment bonds, which I've highlighted here. So they're saying investment in bonds, C not 5.3. So I went to 5.3. I think I managed to do the financial calculation for the I. The cost of debt, actually. I managed that, but I couldn't figure out how to come up with the carrying amount of this.
What date are we at? Which year are we in currently?
Sorry?
What is our financial year end? What's our current financial year end?
Sorry, I lost you there.
What is our current financial year end?
Let me check. It should be 1 minute. Let me just quickly check. 30 September 2010.
Okay, go back up. Okay, scroll a bit down. Okay, try to show the whole of 5.3. Okay. There shouldn't be a difference.
Sorry?
There shouldn't be any tax difference. It mustn't be deferred tax. So I'll show you now. Just take a picture of 5.3, send it in the group, and then stop sharing. I'll do it quickly for you.
All right, no problem. Let me do that.
I'm gonna stop your screen.
Okay.
Okay, so I'll quickly do it for you. Okay, so you want the carrying amount. So remember, for deferred tax, you need a date. So we currently 30th September 2010. That's what we have. The thing is investment in bonds. We need accounting carrying amount. We need tax base. Then we'll have temporary difference. Temporary difference, carrying amount, tax rate, temporary difference, and then deferred tax at your tax rate. So for your guys' purposes, your tax rate is 25.75%. Okay, so if I do my workings, So I do my workings. The first thing you want to do, you need to work out the effective interest rate. So the first thing we need to work out the effective interest rate. So that means I need I. To get I need the other numbers, which is present value, future value, PMT, and N. So we want I. Let me get the information quickly. Okay, so we want I. So
our present
the present
X.
value is the fair value that you paid. Okay, so they say fair value and cost on date acquired. So it's a 2.8. So 2.8 million. 2.8 million. 123, 123. Okay, so this is our African question. So I'll just change that to 28%. So present value is the amount you paid for it, which is a 2.8 million. Remember, present value, we always make negative. Future value and payment, we make positive. Future value is the lump sum payment at the end. All we can assume is that it's going to be the 3 million, the par value. Okay. Your payment is the 9% times the face value. So we pay in arrears. So it is equal to face value, which is 3 million, times the 9% annual in coupon rate. Then N, we have it from 1 October 2009 up until 30th September 2013. So it is 30th September 2010. So that's 1 year, 11, 12, 13. 30th September 2010, 11, 12, 13. So it's 4 years. So my I is going to be, rate equals, they want payment, they want number of periods, they want payment, they want present value, they want future value, and they want type. They say payments happening at the end of each year, so type is 0. And then they want a guess. Whenever you work out a interest rate in Excel, they want a guess. On a financial calculator, there is no such guess. So I usually just take 10%. Okay, so there my rate is 11%. So that is my effective interest rate. Now I need to work out the carrying amount. So the carrying amount using amortized cost is the balance at the end of 2010. So it's the balance at 30th September 2010. So effectively, I want my present value. So I want the present value at 30th September 2010. So by working out present value, I'm going to need my future value. I'm going to need PMT. I'm going to need N, and I'm going to need I. I is your effective interest rate. We calculated that above. So I is my effective interest rate. So I'm calculating it above. So this coming from working 1. I want the present value, so I need everything else. My future value remains the same. My future value is the lump sum payment at the end of the period, which is 3 million at the end of the period. My payment remains the same. It is 3 million times 9% coupon rate each year, which is 270. But now my N changes. My N is the remaining number of years. I am at 30th September 2010. So the remaining number of years is 2011, 2012, 2013, which is 3 years remaining. Each year is 1 payment. So it's 3 times 1, which gives me 3. So if I work out present value now, that's my rate. That's N. That's PMT. That's future value. They want the type where the payments happen at the end of the period or the beginning of the period. It happens at the end of the period, so it's 0. So my present value is 2.8 million. So therefore, all I'll do, my carrying amount, is 2.8. It's an asset, so it's positive. My tax base, they told me the tax treatment is the same as amortized cost. So therefore my tax base is going to be exactly the same. My temporary difference is carrying amount minus tax base, which is 0. So my deferred tax is simply temporary difference times 28%. So there we go. There's no deferred tax on investment bonds because they said under tax treatment that SARS is going to accept investments bonds to be at amortized costs. Accounting treatment is amortized costs. What you call it is, I'm assuming it's at amortized cost. I never saw anything different unless there's any information above that changes it. But I'm assuming it's at amortized cost. SARS is also having at amortized cost. So therefore there can't be any difference. Therefore there can't be deferred tax. Hope that explains. I don't know if that's the answer, but that based on what you showed me, that should be the answer.
All right. I think the entry, the I is fine, but I think on the carrying amount, there is a difference there. So maybe I can share my screen or share the solution on WhatsApp.
Yeah, so you can share your screen.
Okay. So this is the text. This is the carrying amount which is on the debt, which is 3215. And the text base is 2842.
Now where are we? Oh, okay, yeah. Okay, but then how did they get that? So I need to see how did they get that.
So on 8, if you look down on 8, I think the cost of capital, the I is fine. It's 11.16. I'm not just figuring out how they got that 3215.
Maybe I maybe need to read the full question. So you see the tax base is amortized costs. So perhaps they have chosen not to use amortized costs for accounting purposes. So if you have a look at my tax base, it's that 2.842. So you see then 5.3 is not the only information I need to read. There must be more information I need to read if they're getting something else. Perhaps they have chosen fair value as an option. So send me the scenario. So I need to go through the entire scenario. I can't then just look at 5.3. I need to read the entire scenario, because there's certainly information that is I need to factor into account that I've not factored into account by just looking at 5.3.
All right. Thank you, Faiz.
Okay, so most likely the company have elected to value this debt at fair value. So then it's most likely that could be the reason. So share it with me and then I can have a look. But as you can see, we look at the tax base in your solution. It is the same as what we have over here with a minor rounding difference. There's going to be a rounding difference because Excel goes forever and ever, whereas they're probably using a financial calculator. So the answer was 2842,480. Mine is 2842,368. That is purely rounding differences, so we won't worry about that. But the carrying amount is different because there must have been more information above 5.3 or below 5.3 that changes what they are doing over there. Because remember, the way you have to do a carrying amount for accounting purposes is all, if you remember the financial instruments lecture, how do you deal with subsequent measurement for a financial asset? It all depends upon how you classified the asset at initial recognition. How do you classify a financial asset? Using the business, by doing that business model cash flow characteristics. So you might just have a look, how they have elected to measure financial assets. Okay, so I will stop it here. I'll read through it and I'll give you an answer in the chat. Okay.
All right, thank you very much, Vice.
Okay, pleasure. Okay,
All right.
bye-bye.
Thank you.
Pleasure.
Thank you.
Bye.
Bye.
Thank you. Bye.
Thank you. Please don't
Yeah.
forget to share the previous links to the videos you've done.
Yeah.
Okay.
Cool.
Thank
Bye-bye.